Australia has some of the most expensive housing on the planet, but tucked inside that market, advertised on Gumtree, on Facebook Marketplace, on regional real estate boards, there are homes listed for $30,000, $50,000, sometimes less than a decent used car. And almost no bank in the country will give you a standard mortgage to buy one. I know that sounds insane. It's not. The reason isn't your credit score. The reason is the home itself. This isn't a glitch. It isn't a few edge cases. It's a structural feature of how Australian lending works, one that real estate platforms like Domain and realestate.com.au list freely without mentioning. The homes exist. The listings are real. But the gap between I can afford this and a bank will fund this is wider on cheap properties than on expensive ones. Ask any mortgage broker working in regional areas, and they'll tell you the same thing. The cheaper the property, the harder the finance. Here's why. Let's start with the home type that gets the most hype right now. Tiny houses on wheels, THOWs, have built an entire cultural movement around the idea that you can own your space outright, live simply, and sidestep the bloated housing market entirely. Platforms like Instagram and YouTube are full of builders and owners in New South Wales showing off 20 square metre dwellings with lofted bedrooms, composting toilets, and solar panels. The price tag for a new build typically runs somewhere between $60,000 and $120,000. For a second-hand one, you can find listings well below that. By any measure, these are affordable homes. Except to a bank, a tiny house on wheels is not a home. It is a vehicle. When a THOW is registered, as it must be to travel on public roads in New South Wales, it is classified under the same legal framework as a caravan or trailer. The registration is the problem. The moment those wheels are there, the moment that structure is road legal, the financial system recategorizes it entirely. A standard home loan in Australia is secured against real property, land and the permanent dwelling affixed to it. A THOW sits on neither. It's chattel, it's movable, it's a depreciating asset in the same category as a vehicle. What that means in practice is that if you want to finance a tiny house on wheels, you're almost certainly looking at a personal loan or a caravan loan, not a mortgage. Those products come with shorter terms, higher interest rates, and lower borrowing limits. Where a mortgage might carry a rate in the low to mid single digits over 25 to 30 years, a caravan or personal loan typically runs over 5 to 7 years, sometimes at rates well above that. The monthly repayment on the same amount of money is dramatically higher when spread over 7 years instead of 25. The affordability advantage of the cheap home evaporates in the financing structure. Here's the detail that makes this especially pointed. The wheels are precisely what makes a THOW affordable to build and to move. The builder doesn't need a full DA, doesn't need a permanent foundation, can set up on rural land under different planning rules. The wheels are a feature. And the wheels are the exact reason the banks won't touch it as a mortgage product. What makes it flexible for the owner makes it unacceptable as bank collateral. The structure can be driven away, the bank's security disappears with it. Some specialist lenders and credit unions have started offering secured THOW products, but these remain niche, come with conditions, and are not the standard home loan that the mainstream market runs on. If you're a $1 buyer looking at a $70,000 tiny house on wheels, the mainstream banks are not competing for your business on that transaction, and for buyers trying to enter property ownership with limited capital, that distinction is brutal. You've found the affordable option. The system just decided it doesn't count as a house. Queensland has thousands of permanent residents living in caravan parks. Not tourists, not weekenders, people who use a park home or an on-site van as their primary long-term residence. In some regional and coastal areas, these parks function as full communities with residents who have lived on the same site for a decade or more. The homes themselves, manufactured cabins, fixed vans, park homes, can be purchased outright for $40,000 to $100,000. On paper, that's housing. In practice, it's something the standard mortgage market doesn't recognise. The core issue here is land. When a bank writes a home loan, what it is really doing is taking the land as security. The land is what holds its value. The land is what the bank can sell if the borrower defaults. In Queensland caravan parks, the land belongs to the park operator. The buyer owns the structure sitting on it, but not the ground beneath it. They hold a site lease, not a title. And a site lease is not the kind of security a standard mortgage is built on. That distinction produces a strange situation. You can negotiate a purchase price, sign a contract, change the locks, pay rates and maintenance, and live in that home for years. You can sell it to someone else. But you cannot take that purchase to a major bank and get a standard home loan, because the bank's usual claim, the ability to repossess and sell the property, land included, simply doesn't exist here. The land isn't yours to pledge. Residents in Queensland's park home communities have watched this problem play out for years. They'll tell you straight. The banks look at the paperwork and they look at what they can actually take if things go wrong, and a leasehold structure on someone else's land doesn't give them what they need. The Queensland Government has enacted specific legislation to protect long-term park residents. The Manufactured Homes, Residential Parks, Act covers issues like rent increases and minimum lease terms. That protection has improved life in parks considerably. But it hasn't changed the fundamental finance problem. A protected lease is still a lease, and a lease, however secure, is not freehold title. This matters especially in coastal Queensland, where some caravan park communities sit on land with significant underlying value. The park owner holds a very valuable asset, the resident holds a very insecure one, and the buyer, looking at a $60,000 park cabin in a coastal town, is shut out of standard finance not because the home isn't real or isn't lived in, but because the ownership structure doesn't map onto the collateral model that Australian banks were built around. Some lenders will finance park home purchases through unsecured personal loans. A small number of specialist financiers have developed products specifically for the manufactured housing and park home market. But the interest rates and terms reflect the lender's assessment of the collateral risk, which is, in plain terms, higher than a freehold property. You may own the cheapest home in your postcode and still face the most expensive borrowing conditions. Checkpoint. The pattern so far is clear. What makes these homes affordable is exactly what makes them unfinanceable through standard channels. But the next case introduces a different angle. It's not about wheels or land tenure. It's about a single word that banks use constantly and most buyers never think about until it's too late. One word that cost one Victorian buyer their entire loan pre-approval. Victoria has a significant market in relocatable and transportable homes. These are factory-built or kit-constructed dwellings, steel-framed, prefabricated, assembled off-site, that can be delivered and installed on a block. They're popular in regional Victoria because they're faster to build than a conventional construction, often cheaper per square metre, and can be installed on rural properties where a traditional builder won't travel. Prices for a basic transportable start around $80,000 to $150,000, depending on size and finish. When you add a freehold block of land in regional Victoria, the combined price can still sit well below what a standard established home costs in Melbourne. The finance situation for transportables in Victoria is nuanced, and the nuance matters a great deal. A transportable home that has been permanently affixed to freehold land, bolted to a concrete slab, connected to services, with a council-issued occupancy permit, can potentially qualify for a standard home loan. Commonwealth Bank, for example, has a construction loan pathway that can apply to transportables and prefabs under certain conditions. That's the exception. The friction comes from the word permanently. If the home hasn't been permanently affixed, or if the lender's valuer determines that it retains the characteristic of being movable, even if it hasn't moved in 10 years, the loan application hits a wall. The reason is depreciation. A conventional brick-and-mortar home in Victoria is expected to hold or increase its value over time, largely because of the land. A transportable that isn't treated as a permanent fixture can depreciate like a manufactured good. It has a functional lifespan. It can, in theory, be loaded onto a truck and removed. To the lender's risk model, that possibility, however unlikely in practice, changes the collateral calculation entirely. Valuers working in regional Victoria have noted this dynamic directly. A transportable on a rural block can be appraised at a value significantly below its replacement cost, because the valuer factors in depreciation and the potential difficulty of reselling it to a buyer who would also need non-standard finance. It becomes a self-reinforcing cycle. The home is cheap, the finance is hard, the resale pool is narrow, which keeps the price cheap, which keeps the finance hard. There's a critical structural move available here that most buyers in this market miss. If you own the land first, if you hold freehold title to a block in Victoria, and then commission a transportable home to be permanently installed on it, a construction loan through a lender like Commonwealth Bank or a regional credit union becomes a realistic option. The land is the collateral anchor. The home is the improvement. That sequence changes the lending conversation entirely, but that sequence requires capital upfront to secure the land, which is precisely what buyers in this price range often don't have. The mechanism that could fix the problem is locked behind the problem. The honest drawback of this market beyond finance is worth naming directly. Regional Victoria is a long drive from Melbourne's hospitals, employment hubs, and services. Some of the cheapest blocks where transportable homes are most cost-effective are genuinely remote. Towns where the nearest hospital is an hour away, where mobile coverage is patchy, and where severe weather events, including bushfire, are a real planning consideration. The cheap home is cheap partly because of where it is. That's not a criticism, it's context. Checkpoint B. There's a version of this problem that has nothing to do with the structure of the home at all. It's about the land around it, or more precisely what can happen to it. The next case involves properties where the cheapness is a direct reflection of risk, and where one specific government-issued rating can drop a lender's maximum loan-to-value ratio from 80% down to figures that make a loan functionally useless. There are towns in western and central New South Wales where you can find a 3-bedroom house on a full residential block listed under $100,000, sometimes under $50,000. The properties are real. The listings are on realestate.com.au. The towns have post offices, schools and pubs, and when buyers try to finance these purchases through a standard bank, they frequently get told no, or they get told yes. But the conditions are so restrictive, the loan isn't functional. The issue unfolds across several dimensions simultaneously. First, there is the question of insurability. A standard Australian home loan requires that the property be insured. If a property sits in a designated flood zone, a high-severity bushfire risk area, or has other hazard ratings that make it uninsurable through mainstream providers, the loan falls over. Insurance companies have been progressively tightening their underwriting criteria for high-risk regional NS Ostlers properties over the past decade. Some areas that were insurable 5 years ago are now refused coverage by every major provider, or quoted at premiums so high they become economically irrational. No insurance, no mortgage. That's not a bank policy preference. It's a structural requirement of the loan. Second, there is the loan-to-value ratio problem. Even when a rural NESAV property is technically insurable, a cheap rural home in a remote area may attract what lenders call a low maximum LVR. Where a standard metro property might support an 80% or even 90% LVR, a small dwelling on a large rural block in an area with a thin resale market might be assessed at 60% or 50%. The bank is acknowledging that if it ever needed to sell the property, it would struggle to find buyers quickly and might not recover the full loan value. That means the buyer needs a much larger deposit, sometimes large enough to make the transaction impossible for the exact buyers who are drawn to the low price. Third, and this one is underappreciated, there is the serviceability of the property itself. A home without reticulated water, without sewage connection, without reliable power, and without road access that meets certain standards may be deemed uninhabitable by a lender's valuer. Not in the sense that no one is living there, but in the sense that the bank's risk model doesn't recognise it as a standard residential asset. A homestead on a large rural block that relies on tank water, a septic system, and a dirt track off a state highway is a different collateral proposition than a brick veneer on a serviced suburban lot, even if the person living there is perfectly comfortable. Locals in these towns, people who have owned their homes outright for decades, who bought before the LVR calculations tightened, who didn't need a bank to tell them what the property was worth, will point out something that's difficult to argue with. These houses are lived in. These towns are functioning. The problem isn't the homes. The problem is that the bank's valuation system was built for a different kind of market, and when it encounters a cheap rural property in a small town, the model generates numbers that make standard lending unworkable. The cheaper and more remote the property, the less the bank will lend against it. It is almost a rule. There are lenders who operate in this space. Regional banks, some credit unions, and specialist rural lenders have products designed for low-value rural properties. Agri-lenders who understand pastoral and mixed-use blocks have different risk frameworks, but their rates and conditions reflect the risk assessment, and the buyer ends up paying more in financing costs on a $60,000 property in rural Nessells than they would on a $600,000 property in Sydney. The system extracts more from the buyer who can least afford it. Here is where the full absurdity of this situation crystallizes. There is a category of property, not a fringe case, not a novelty, but a documented segment of the Australian market that is too cheap to mortgage, not because of what it is built on, Not because it has wheels, not because of flood risk or bushfire hazard, just because of the number. The purchase price is low enough that no standard bank home loan product applies. The cheapest dwellings in Australia, and we're talking about properties that genuinely exist and are genuinely listed, in the rough price band from around $20,000 to $150,000, often sit below the minimum loan size that major Australian lenders will write as a home loan. This band is indicative, not a fixed legal threshold. Different lenders draw the line at different points. But the structural effect is consistent. Below a certain dollar figure, the bank's home loan machinery stops being available. The economics of originating, processing and servicing a $40,000 loan don't work for a major bank the same way a $500,000 loan does. The cost of compliance, valuation and administration is roughly similar regardless of loan size. On a large loan, those costs are absorbed. On a very small loan, they eat the margin entirely. The median price across this segment of the market runs around $75,000, and that figure already puts it below what most of Australia's mainstream lenders will consider as a home loan. The buyer of a $75,000 dwelling is almost certain to be pushed toward a personal loan or a caravan finance product, depending on the dwelling type. Personal loan rates in Australia routinely sit between 7 and 14%. Home loan rates, at the time of writing, are considerably lower. Spread over a shorter term, personal loans rarely run past 7 years. The repayment on a $60,000 personal loan can match or exceed the repayment on a $200,000 mortgage. You might think that sounds like a mistake. It's not. Run the numbers. This is the cleanest expression of the paradox. A home that costs $60,000 may cost its buyer more per month in repayments than a home that costs $300,000, purely because of the financing structure that the cheaper price forces them into. The cheapest homes in the country are generating the most expensive borrowing conditions for the buyers, least positioned to absorb them. Ask mortgage brokers who work in regional and remote areas, and they will tell you this is one of the most consistent and frustrating patterns they encounter. Clients who find genuinely affordable housing and then discover that the affordability is effectively neutralized by the finance market. There are alternative pathways. Some credit unions and mutual banks operate with lower minimum loan sizes and are worth approaching. State government programs in some jurisdictions offer low deposit or first home buyer products that can reach further down the price scale than the major banks. And for buyers with existing assets, equity in another property, sufficient savings to buy outright, or a family guarantee structure, the financing problem is solvable. But for the buyer who has spent years trying to accumulate a deposit and has found a $60,000 house as their entry point into ownership, those pathways involve a level of complexity and condition that the straightforward home loan product simply doesn't. The harder truth here is about what the system reveals when you look at it from the bottom up. Mortgage lending in Australia was designed around a particular asset profile: freehold land in a serviced area with a permanent dwelling and a resale market. When every one of those conditions is present, the machine runs smoothly. When any one of them is absent, no freehold, no permanence, no services, no market, no minimum price threshold, the machine stops. And the properties where those conditions are absent are almost always the cheapest ones. It's not a conspiracy. It's not a deliberate exclusion. It is a system built for a specific market that simply doesn't extend downward. The outcome, regardless of intent, is that the cheapest homes in the country are the ones that attract the worst financing conditions, the narrowest lender options, and the highest effective cost of borrowing. And the buyers who find them are often the ones who can least afford that outcome. The minimum loan floor, the collateral model, the LVR framework, the insurance requirement, these are not arbitrary bureaucratic hurdles. Each one exists because of a documented lending risk. But the aggregate effect of all of them, applied simultaneously to properties in the $20,000 to $150,000 range, produces a market outcome that is genuinely difficult to defend. A buyer with $15,000 saved and a stable income, looking at a $60,000 house in a regional town, faces financing conditions that make ownership structurally harder than it is for someone buying a $700,000 property in a capital city. The system doesn't treat these buyers equally. It doesn't pretend to. That is not a flaw in the system. That is the system, operating exactly as designed. And that is why Australians are finding homes they can afford, but can't get a normal mortgage for. Cheap homes, expensive financing. The gap between what something costs to buy and what it costs to borrow against is not fixed. It shifts depending on whether the home has wheels Whether the land is yours, whether the price falls below a threshold, a bank decided matters for its own margins. The question isn't whether these properties are real. The question is who the mortgage system was actually built to serve, and whether that design still makes sense. Which of these 5 property types would you try to navigate first? The tiny house on wheels, the park home, the transportable on a rural block? Write it in the comments and tell us why. If understanding how these systems actually work is useful to you, subscribe. There's more